Hello and welcome to Wider Path Home Foundation. I am Sarah Hobson and I'm with Embrace Home Loans and with Wider Path Home, the foundation of Embrace Home Loans. And we are here with Audley Lewis, who is a very senior loan officer in Hampton Roads, Virginia. And he is going to walk us through what it's like to get pre-approved. And I'm the perfect person for this because I have not yet purchased a home. So I'll be the first time home buyer that I am. Audley, welcome.
Thank you, Sarah. It's a pleasure always being with you and sharing with you and the public that we have that are in need of good resources and information.
So Audley, can you walk us through, we're gonna basically in this session, we're gonna talk about for first-time home buyers, what do you need to know and be able to understand about pre-qualification versus pre-approval for a loan and what they both entail, and also what it means to get an interest rate, especially in this market. We can even talk a little bit about this market, Audley, and how you lock in your interest rate. You know, if you get a good interest rate, how do you hold on to it? And then also, what are discount points? Sometimes you'll find that as you're researching different mortgages. And we'll also look at what a loan estimate is and how it works. So what you can expect on some of the paperwork. And these might be some of your questions that I've just outlined. And so we're gonna just jump right on in. We wanna know, Audley, definitely about like when you're calling a mortgage lender and learning how to find, we've gone through how to find a loan officer in our previous sessions, but how do you ask a lender? What do you wanna talk to them about? And what should they be telling you? What kind of information should they be providing? And what kind of financial information should you be prepared to submit? And so we're gonna jump right on in. Can you first just tell us, Audley, what goes into a mortgage? We've gone through this in previous sessions, but just to help us understand, when you're paying a mortgage, what is it that you're paying?
Well, when you're paying a traditional mortgage, you're paying principal, interest, taxes, and insurance. The principal and interest is determined basically by the amount that you're borrowing and the rate of the interest that you're paying on the property. And then the taxes and insurance taxes is determined by the jurisdiction that you're living in and what the tax rates are. And insurance, quite naturally, is subject to the property condition and things of that nature, as well as your credit, as far as that's being determined. So insurance would be including homeowner, hazard, and flood insurance, and any other mortgage insurance that you may have on the property. And when we look at mortgage insurance, it deals with the potential default of the loan. I've had people say, well, you know, I need mortgage insurance because if someone passes away, I want to make sure that the property is paid off. It has nothing to do with that. It has everything to do with ensuring the lender to make sure that they can recoup some of their resources that they have placed into this loan. And so, you know, principal is the balance of the money lent, excluding interest. Remaining balance of the loan. Interest is the amount the lender charges to borrow the money, expressed as percentage. And you'll probably hear in the marketplace what rates are in the twos and whatever, but it's all going to be dependent upon, as far as interest rates, depending on your credit score and the amount of money that you're borrowing. Taxes relate to, quite naturally, the real estate taxes assessed by the city or the county, and it's paid depending on the jurisdiction, anywhere from once a year to sometimes 4 times a year. So you have to know basically the jurisdiction that you're in and how it's being taken care of.
That was incredible information. That was so incredibly helpful. So my interest rate is going to be dependent upon my credit and my credit score in particular, and how much of a loan I'm taking out. So super helpful to keep that in mind. Okay, so let me take you over to the next one. To know if I'm ready to have a mortgage, can you help me understand some of these concepts that go with just a home buyer, first-time home buyer being ready for a mortgage?
Um, to determine your purchasing power and evaluate your readiness for committing to long-term debt, we need to know basically what your debt is in relation to the amount of money that you make. And when we use the income, we're using gross income. So you've got to keep in mind that we're not assessing what you bring home net after taxes. We're not assessing any other expenses that you might have outside of the mortgage itself. So we're not looking at what you're going to pay for utilities and things of that nature. That being said, the ratios are going to be determined by the amount of total debt divided by the amount of total income. And ideally, they say that you should be within that 43 to 45%. However, with the automated underwriting systems and the guidances that we have at the different lending institutions that we have, it can actually increase and go beyond that. It depends on whether it's an FHA, a VA, or a conventional loan. I know that for most lenders with a conventional loan going over 50% total DTI is a no-no. The automated underwriting system may not take it. And with an FHA loan, it may be flexible up to 50, 55%. On a VA loan right now, depending on the lender, it can go as high as the automated underwriting system would accept.
That's incredible information. So when I'm going to a lender, they are going to ask about my debt to income ratio, my DTI, and that has everything to do with how much I make in gross per month and how much debt I am paying off per month. And there is a percentage that is a value that comes out of the division between those two concepts that determines
Yes.
for them if I'm going to be able to make my mortgage payment, if they feel safe
Absolutely.
with me being able to make my mortgage payment.
Absolutely.
This is
And
so exciting. Yes.
quite naturally, the lower the number, the better you should be able to feel as far as being comfortable with, acquiring a mortgage. The ideal situation is to keep your housing debt no more than 30% of your total income.
Gotcha. So a lender will want to see that my housing debt or my house, what I'm paying towards housing now is at a DTI of 30% or below to put me in the best position for them to feel confident that the loan they give me will mean that I can pay my mortgage daily, monthly payment.
It would be ideal, but oftentimes we live in a real world, right? And we're going to kind of skirt around what's ideal to make loans happen for the consumer. The most important thing is that we make a loan affordable for you and available for you as well.
Gotcha. So you're working with me on the full picture as a lender to understand my full
Absolutely.
situation. Yeah. Yeah. Okay. Super helpful. I'm so excited I'm getting this. Okay. So can you tell us about pre-qualification versus pre-approval? What is pre-qualification? So if I am calling a lender and this happens, as far as I understand, you can correct me if I'm wrong, but this happens before I actually go and make an offer on a home. Let's say I've looked at some homes, or even before I look at homes, maybe, right? I've got to have some kind of sense of whether or not I qualify for a loan to be able to even say to a homeowner that I can purchase your property.
Okay, so pre-qualification is going to have more to do with um, income and debt versus anything to do with your credit. So based on the amount of income that you make and the amount of debt that you have and possible mortgage that you might incur, that calculation is made to tell you what you pre-qualify for. However, this gives you less negotiating power. It just talks to you about simple, not necessarily credit worthiness, but financial worthiness to be able to acquire a loan. It's an informal estimate of your purchasing power based on an evaluation of your financial information.
Okay, and that's the pre-qualification?
Yeah, that's a pre-qualification. Now, I will say pre-qualification in this marketplace and any marketplace, even prior to it being the market being as hot as it is, really has no place in the industry besides for personal knowledge. What sellers and realtors are looking for is a pre-approval, which means that your credit has been looked at, and we can solidly say within a 90% plus range that you will be able to go to the closing table based on the information we've acquired.
Okay, so that takes us to pre-approval. So can you tell us a
Mhm.
little bit more about pre-approval and which one you would recommend? Should we go for pre-qualification or should we go for pre-approval?
Well, it's hands down a pre-approval because that's what the marketplace is looking for. But it's a written, formal, conditional commitment of specific mortgage amount based on a review of all financial information. It requires a mortgage application, includes thorough investigation of all your financial information, verifies your employment history, income, debts, assets, credit, and credit scores. Now, I will say that you can acquire a pre-approval without actually submitting documentation, that you can get a pre-approval based on the information that you provide. And hopefully when you speak to a lender, you're telling them what the facts really are. You're not inflating or embellishing any information. And so then later on, it can be verified by the documentation that we acquire from you.
Okay, so it might be that a lender would say to you, I need your documentation so that I can get you more formally pre-approved. Or it
Correct.
might be that a lender will say to you, yeah, tell me what your income was. Tell me what your
Mhm.
employment situation is. And as long as you're factual, you'll get a pretty strong estimate of, of what you would be
Right.
pre-approved for. Mhm.
Yes, and that's more like what the market is. When you call a lender and you're getting a pre-approval, oftentimes they're just going to get the information that you will verbally state or even put in electronic application, and they can work up a pre-approval based on that. The pre-approval is always going to state that it's, subject to the information that you have shared being verifiable.
Gotcha. But you need that letter to be able to put in an offer on a home.
Absolutely. Absolutely. If I was to describe it, I would say it would be a buyer's golden ticket to go shopping.
The golden ticket to go shopping. I love it.
Yes.
So you got to have that pre-approval letter, which hasn't been formally approved. You haven't put
Mhm.
all your paperwork in yet, potentially, although there are some who will get that going a little bit earlier. But as much information as you can give the lender to help you feel comfortable that once you go through that formal process, you will have everything lined up for the home of your dreams. That's important too. But having that ticket to go shopping, you can at least get that going. What's the paperwork that a lender is going to ask you to submit?
The paperwork is pretty simple and really light. Not, I guess, as a lot of people anticipate. It's usually, 30 days of current pay stubs, 2 to 3 months of bank statements, checking and savings for all accounts, including any youth or joint accounts you're on. The last 2 years of W-2s, really, unless you're a business owner in a 1099, then you might need 2 years of tax returns. Any other documentation that your lender may request or that may apply to your situation, i.e., if you're paying child support, we would need proof of that. If you're in a situation where you're separated, we may need a separation agreement. If you're in a situation where you're leasing a property out, and this would not apply to a first-time homebuyer, but if that's the case, we may need a lease. Um, we need to be able to verify your income and your employment and other relevant information. And it's pretty simple. We're going to need copies of your ID, to make sure that the person that we're giving this loan to is truly the person we're giving the loan to, right? In this age of, you know, identification theft and fraud, we've definitely got to have two sources of ID. It's very important.
And is all that information protected? I could see, you're just starting out down the path of talking to a lender and getting pre-approved. And are you stuck with that lender? What if you don't like your pre-approval? Or what if there's something that they need differently, that you feel like, I don't know that I want to give that information. What would you say to somebody who's saying that's a lot of financial information?
I would say, first of all, that as a new home buyer, you've got to realize that everyone in the process works for you, right? You employ everyone. So if you're not feeling comfortable with how you're being treated, the focus, the attention to detail, as far as your particular situation is not being attended to, then you may want to shop around. And people are apprehensive to shop around because is this going to be a hard hit on my credit, is what I hear all the time. And I'll just share this with you. If you've had your credit pulled by a lender for a mortgage and you're not cross shopping, but you're going to shop for a mortgage with another lender, it's perfectly fine. The other lender will pull the identical score within 30 to 45 days of the actual first pull. So, you have choices and you have the ability to choose what's comfortable for you, what feels right. And as a first time home buyer, you ought to know that. And you need to know that you have control of the situation that you're getting into.
So I have a bunch of follow-up questions to that. One is, are all the lenders required to protect my financial information?
It is a requirement to protect your private and personal information, and usually you'll see things transmitted in secure documents where you'll need a password. However, because of the age of information and people usually transmitting things through email and text messages, some people are a little cavalier with sharing information, which we discourage. Usually the lender will send out a secure portal that you can upload all that personal private information so that there is not a breach in your with your personal private information.
Okay, so that's important. If they're asking for the information and you're sending over tax documents and things like that, it's a good idea to send it securely also,
Absolutely.
because they have
Absolutely.
their own private portal for where they're putting your documentation, and your information is protected. They have to be pre-approved, right? For
Right.
to be approved by the government and by the industry to make sure that your information is safe with them. Is that right?
Right. If we're going to be responsible lenders, absolutely.
So you want to see some of those. You can ask those questions if you need to make sure that you feel good. Um,
Yeah.
and then the other question I had on that is, as you're shopping around, if I get a pre-approval letter from one lender, and then I find out later on that when I go through the approval process, that the rate that they gave me for my interest actually jumped up in a way that I'm not comfortable. Do I have to keep with that lender, or can I go to a different lender?
Well, first and foremost, when you're getting a pre-approval, oftentimes the rate is not locked. Why? Because you don't have a property that the rate can be locked on. And so the pre-approval would be reflective of the current rate the day that you're pre-approved. That's usually why there's a time limit, first of all, on the pre-approval because of when you have your credit pulled and things of that nature, but also the fluctuation in the marketplace. That rates do change, and until you have a rate locked, it's subject to change. And what needs to happen is the borrower, you need to know that the rate that you're quoted at pre-approval may not be the rate that you receive once you have a ratified contract.
Gotcha. So then is it okay if the rate changes, or if I don't like something about working with the lender I'm currently working with, is it okay to go to a different lender? Let's say I get a
Absolutely.
home and I've got the pre-approval letter from a different lender, but now I'm like, I'm not so comfortable with this lender. Can I switch lenders?
You can, and usually it's going to be with the approval of the sellers. All right. It usually states it in the contract. If there's going to be any change in the lender that they have seen the pre-approval from, it's subject to their approval whether or not you can change, but absolutely you can.
Okay, super helpful, super, super helpful. So if the rate changes and you find yourself in a bad position and you need to shift it up, or if something with your lender isn't coming along smoothly enough, you can shift, and it might just be a conversation with the seller. Thank you so much for this information. This is such a relief to have the chance to ask these questions. And you mentioned this also, but locking in a rate, is there a way to get the commitment in writing of a rate, or is that something that the lenders don't have control over?
When you lock in a rate, first of all, it should have been discussed with you, the borrower, what the rate is, the current rate is, and whether that's something that's acceptable for you. And so once the rate is locked, there is generated to you, and should be, a rate lock agreement along with a loan estimate. Those two things are tied in together. And so you will be receiving that, and that would be your commitment in writing. And make sure that when you lock the rate, that it's locked at a long enough term to enable you to close. And why do I say that? Because if you lock and you go for the rate based on the term of the lock, and it doesn't cover you to be able to get to closing, then there may be some fees that you will incur for extending the rate lock. So what looks good at the beginning may not be good overall for you, the consumer. Is there a commitment fee for locking in the rate? In most cases, not. I believe USDA may have a commitment fee. I think it's $150 or so. I could be misquoting. But normally there is no charge to lock in a rate. You want to find out whether the rate that you're locking, what it includes. Is there an upfront origination fee? Is there a discount point that has to be paid to get that particular rate? Because we can quote rates all day long, but knowing the particulars that are related to that particular rate, you need to know that. So you need to know what the cost of the money is, in essence.
This is incredible. This is incredible information. So the rate, okay, here's my follow-up question on this. Here's where my head goes. Is it a part of the pre-approval letter that they're locking in the rate, or is it a separate written commitment that comes? And when does that written commitment come for that rate lock?
It's a separate written commitment that comes, and it usually comes after you have a ratified contract, because you have to have a property to place that lock with. We do, however, at Embrace Home Loans, have the ability to lock a rate on what's called an approved to move program. And that's a program that actually takes someone completely through underwriting and full approval without having an address.
Wow. And that includes a rate lock, all in the pre-approval.
Yes, you can do that. Yes, absolutely.
Okay, so and that's different from a lot of lenders, it sounds like.
It's unique to Embrace, as far as I know. I'm not sure. I can't speak for other lenders, but I can speak for the awesomeness of what we do here.
That is so exciting. That's super exciting, because it sounds like you're saying usually the rate lock comes after you've gotten the purchase all the way approved and the contract approved, and that you need to know the term of the rate lock. So that was a really important information. It's pretty rare to be able to lock that rate in ahead of time.
Yes, yes.
So you mentioned discount points earlier. What did you mean by them? Can you define that for us?
Okay. Let me explain to you, first of all, what a point is. If we're talking about 1 point, it's equivalent to 1% of the loan amount. So if you're borrowing $200,000 and that's the loan amount, then a point would be equivalent to $2,000, which is 1% of the 200,000. So if someone says a half a point, then you can do the math from there. So a discount point is what's used and oftentimes to buy down the rate or to get a particular rate. So you may have a rate that's quoted to you at no cost, and you want to know, and communication is very important in this process. So talk to your lender. Is there a better rate out there rather than jumping ship? And what would that cost be? And they will explain it to you. And a lender that has your interest at heart will tell you whether or not paying that kind of discount on the particular loan that you're trying to get, whether it's worth it or not. And it's about the time of recuperation of the funds that you're putting out. as a discount, if that makes any sense.
So here's
So
what I'm,
upfront
yeah.
interest paid as part of your closing costs in exchange for a lower interest rate, in
Okay.
essence.
Okay. So that's super helpful. So basically, you can purchase discount points that reduce the rate of interest that you're going to pay over the life of the loan. And so sometimes you can buy down your rate, your interest rate to do
That's
that.
exactly.
Okay. Okay. But my question is that worth it? Is that something you should be worried about that somebody's asking you to buy down the loan rate? How do you decide if it's worth it? I mean, some of my brain goes like this. Well, if I purchase discount points, I pay a little cost up front. Maybe it's a $200,000 home. So I'm paying $2,000 and I buy three interest and three discount points. So that brings my interest rate down quite a bit. So wouldn't that be great? Because then the life of the loan, if I have a 30-year mortgage, then I've actually saved myself money over time. Um, is that how people think about it? Or when and if they're a good idea to do discount points?
Well, there's got to be value in it, first of all, for you as a consumer. Does this effectively bring your monthly payments down to an area in which you're trying to achieve according to your budget? That's one of the criteria or the parameters that you might want to look at. Um, the other portion of it, does it make sense? Would it make sense for you on a $200,000 loan to spend $3,000 to change your rate by an eighth of a point? It may not be worthwhile. So it's up to the lender to give you guidance and use his professional ability and discretion to guide you to make good decisions because you're a first time homebuyer.
So that was really key information there. So it's hard for me to imagine what the math would look like to figure out if buying discount points would be worth it to reduce my payment over time. So you want to have a lender that you trust, that you can have this honest conversation with, who's going to shoot you straight and say whether or not the discount points make sense or not. And there are plenty of online platforms that say, here's how you can buy discount points, and it can look really good, but you want to make sure
Mhm.
you're talking to the lender and making sense of it and making sure that it really lines up with what's going to save you money over time. So what about the fixed rate loan payment? So when you have a fixed rate mortgage, which means that the payment stays the same, the interest rate stays the same over the life of the mortgage, what does it look like in terms of your payments?
Well, what happens is the principal and interest portion, if the rate is fixed, which means that rate stays the same for however long the duration of the loan is, that portion is consistent and constant. What may change is the taxes and insurance piece because taxes fluctuate, they go up and down. Recently, they've been going steadily up. um, and then insurance also, will fluctuate, it will go up more than likely. And so, what happens is on the taxes and insurance piece, um, the lender is going to collect and start an escrow account for you to begin to be able to distribute the funds as needed, however many times a year that the taxes are needed to be paid, and once a year to distribute the insurance.
Great. So they help sort of modulate some of the maybe up and down flow of your mortgage payment by creating an escrow account that they're drawing from to help make your payment. Is that the idea?
Yeah, well, to make sure that those items are paid, one of the things that we have learned over the years is that because taxes takes precedence over most everything, including a mortgage, people have lost their homes with a mortgage still outstanding on the steps of the courthouse in their local jurisdiction because of unpaid taxes.
Oh, so if your lender just takes over the servicing of those taxes for you and tells you what to pay upfront so that you're paying those taxes, is that the idea? Then
Well,
how does that work? Yeah.
Well, we know what we should know if we're originating a loan, what your yearly taxes are. We should have done the research by now, and what the insurance cost is going to be. And so we take 1/12 of that and make that a part of your mortgage payment every month. So you have principal, interest, and then the taxes and insurance piece. And the taxes and the insurance, whether it be homeowners uh, and hazard are the same thing, and or flood insurance. And we're going to take 1/12 of that and put it aside so that it can be distributed when the renewal is required.
Super helpful. So I don't necessarily have to manage all the fluctuation of taxes and the tax payment itself. And I don't have to end up at the courthouse having not paid my taxes and my property being in foreclosure, even though I was making my mortgage payment, because y'all take care of it for me. That's what you're saying?
Yes.
Okay. All right, that's a relief to know. So can you tell me about the costs? Once when you know you're pre-approving me for an amount, but what do I need to know about the whole life of the mortgage and the costs that come with closing on a mortgage and everything that you're talking about with the discount points, with your, you know, how do I pay the lender? How does the lender make money? And then what other costs should I anticipate when I'm looking into just putting down a down payment and um, going in for a mortgage?
Well, you know, you have a variety of fees. One of them is an origination fee. An origination fee is any fee that is a cost that that is passed on to you for the origination of the loan, whether it be an underwriting or processing fee. In some cases, some lenders have just a straight origination fee, and then they have a subsequent processing and underwriting fee. So it all depends, and that's why you need to shop, you know, when you're looking for a lender, to make sure and ask the question, what kind of fees do you have? And what are the costs for those fees?
Can
Um,
I stop you for 1 second there? Can you give us a sense, like what are Embrace Home Loans fees for the origination, and what's kind of the range that you see in terms of what people should anticipate just on the origination front, the underwriting fees, the processing fees, the lender fees?
okay. For our particular lending institution, it's just one fee. We have an underwriting fee. It's 11.95. So no matter what the price point of the home is, it's the same fee for every borrower. Points are fees paid to the lender in exchange for reduced interest rates or also origination. Appraisal is an unbiased estimate of fair market value on what the home is worth, and that's going to be a fee that's charged. Depending on the type of loan that you have, the fee may be a little different, and the type of property that you have as well.
Oh, sorry, can I
They'll
interrupt? What
determine.
roughly what are you looking at when you're paying an appraisal fee? We talk about this in a later session, but roughly what should you anticipate?
An appraisal fee right now is between 510 and 560, depending on the type of loan. Now, like I said, it could exceed that amount based on the size and type of property that it is. Um, then it's going to be revealed to you that there's a cost for title search. And what a title search does is there's an abstract that goes out to the local jurisdiction courthouse to check to see if there are any liens and encumbrances on the property, right? Any outstanding judgments, unpaid taxes, valid claims of ownership, and they will verify that the title or the deed of the property is clear in order for us to generate a loan. And as a consumer, you wouldn't want to buy a property that's got all these things attached to it, right? And so we get to the next point of title insurance. And what title insurance does is it looks at the property based on what the abstract has said, and they insure the property against liens and encumbrances. And this is what gets me, from the day you close on back to infinity, right? So if someone shows up with a valid will and a deed that was never recorded, they can stake claim to your property if it was one prior to yours. And that's where title insurance would help cover you. Now, there is lender title, which is mandatory, and there's owner's title, which is optional. And you just think about it as a consumer, right? You're the borrower. If the lender deems it necessary and important for them to be insured and have this title insured, against a lien or encumbrance, and you're just an individual, why wouldn't you take the optional or purchase the optional title insurance? And I've seen it play out many times over, even on a brand new property, that a lien and encumbrance shows up 15 years after this person owned the property, never did anything, and owner's title insurance allowed the individual to be able to get their deed clear and sell the property. It's very important. A survey is done by a civil engineer, and what it's going to do is mark the boundaries of the property. In a lot of cases, the survey is on file at your local courthouse or jurisdiction. But if you want to install fencing and things of that nature, oftentimes it may be important to get your property surveyed and the markers put back in or exposed. Recording fees are what's charged by your local courthouse or local recording office to record the purchase and the exchange of the property and place it in your name as a borrower. Attorney's fees are what's charged for the cost of doing all the paperwork and also disclosing you at time of closing.
That was incredible. That was so much information. I thought it would also just be helpful for our first-time home buyers to kind of see what a loan estimate looks like. So can you explain to them what a loan estimate is and when they receive the loan estimate? And I'll show them a picture of what it looks like.
A loan estimate is required to be disclosed to a borrower within 72 hours of actually loan becoming a loan, which means that we have all the parts, including an address and your social security number and things of that nature to make this thing real and an actual full loan. Okay, so at that time, they're going to disclose to you the estimates of, first of all, the loan amount is going to be an actual value, the interest rate, hopefully. If it has not been locked, then that too is an estimate, because you do have the ability to say, you know what, the rate is this today. I might want to play and what they call float the rate, which means I'm going to wait and see if it gets any better. I really don't suggest that, but there are a lot of people that like to take the chance and do something like that. So, and so the next portion of it will disclose what the total principal and interest amount is. And as we go further down, if there is any balloon payments, which we are not doing currently, but they'll disclose the principal and interest, the mortgage insurance amount, the amount that's escrowed, which would be your taxes and insurance combined, and that would be an estimated total monthly payment as you're looking at it. Estimated taxes and insurance and assessments. It says it there at 206, that's the same estimated escrow amount. And notice that it says estimate, because the LE or loan estimate is just what it is. There are certain things that are not going to change, but the majority of it may change because we don't have actual information at the time. But it's required that we give the consumer some sort of idea of what this property is going to cost them as they're approaching homeownership.
Incredible. And then the last page of this, it looks like, is the loan costs that included the origination fees, which sounds like they could be somewhere in the $1,000 to $2,000 range, generally speaking.
It would depend on the particular lender. If originations is 1% plus whatever fees you have, it may be more than that. If you're charging 1% origination on a $400,000 home, that's $4,000. And then if you have a processing or underwriting fee, that may also be reflected in line A as origination charges.
So it's good to ask what the origination fee, how the origination fee is calculated. If it's just a standard, as Embrace has, $11.95, or if it's tied to the amount of the house and it's a percentage of the amount of the loan for the house, or how they calculate that. Is that right?
Yes. The next line would be if you brought down the rate. So if you paid a discount, it would be disclosed right beneath the origination charges. So it should be a part of it. And if there is an application fee, then that's there. If there's an underwriting fee, as you can see, it's there. And then in the next section, an appraisal on the particular type of loan that you're on. There's a fee for credit reporting, and depending on what agencies the lender is using, the fee could be a little different. There's always going to be a flood certification fee, because when you do bring a ratified contract in and we begin to disclose it, that's one of the first things that's done, that we have a flood certification done to, first of all, let us know if the property is in a flood zone, and be able to notify the client, the borrower, that you potentially may need some flood insurance, or we may need to get some elevation certificates and things of that nature.
Sorry, can I interrupt on that? Because I've heard realtors say every zone is a flood zone.
Yeah, you've heard the talk of the 100-year flood areas, and right now it seems like many areas have experienced the 100-year flood area over and over again, even places that have never seen flooding or water. Even if it's lack of maintenance of the drainage systems, people are seeing floods in their communities, and quite naturally because of the other things that's going on with global warming and things of that nature.
Tax monitoring fee.
Yeah, and it's all subject to who the title company or the lawyer's office is that's doing the closing, because it'll be subject to the fees that they generate based on their need for research to clear this title, and also to efficiently do the closing for you. And so, as we go down, there's a pest inspection fee, and usually the pest inspection fee is not charged to the borrower, but it's charged to the seller, the property. A survey fee, but all these fees are going to be disclosed if indeed you're going to utilize the service, i.e. Sometimes, I would say more times than not, most people will not do a survey. There's no need for it. There are areas that you may need a survey to mark out a large plot of land that you may be purchasing. But aside from that, and just a standard purchase for a first-time home buyer, 9 times out of 10, it's not an issue. The settlement fee and the title search fee, it's all going to be subject to the individual closing companies and what they're going to charge, and it all depends on the jurisdiction that you live in. Some things are mandated by the jurisdiction that you live in, i.e. that you can only use a lawyer's office versus a title company in some states. So you need to be aware of where you live and what the rules and regulations are. And oftentimes your realtor can give you that guidance as well. Well, on the other side, we'll be talking about prepaids. And what are prepaids? Prepaids are items that needs to be paid at time of closing, i.e., I'm just going to give you one example. You're purchasing hazard insurance or homeowners insurance. They're one and the same, right? There's a premium that needs to be prepaid at the very beginning to start your policy. So you pay a year upfront, right? Also, to start your escrow accounts, there may be 2 to 4 months of the insurance and taxes that's put aside in the prepaids. So you need to be aware of that. And a lot of times people say, well, I just want to know what my closing costs are. Well, closing costs and prepaids are added together in one lump to say this is what your total closing cost is. But there is a separation between actual closing costs and prepaids, and those prepaids was what basically I just shared. And as you look in line H, the owner's title policy, and it's optional. It says it's optional. So there are people that will opt not to get it. Anytime you see optional, I might not want it. But like I said, if the lender chooses to protect themselves, or themselves as an entity, from any liability that would come from anything prior to closing, why would you want to protect yourself as an individual?
it looks like everything's just added up together
Mhm.
and gives you your total with your estimated costs for closing, which can be
Right.
they can be pretty steep. So you do have to be ready for closing costs as well as your down payment, as well as the origination fee, which factors into the closing costs. Yeah.
Absolutely. And if there's any seller credits, it's a rare thing in our marketplace today, but on occasion, seller will give some concession or closing cost assistance. So that would be in that bottom area, as well as if there's any adjustments that's made. Um, for instance, if you get a grant or anything like that, it would be noted in that area and deducted from the total amount of cash to close.
Awesome. So super helpful to get some down payment assistance if you qualify for it. And there are lots of places to get that down payment assistance. And we cover that as well in our videos and in our series. But definitely lots of good down payment assistance out there that can also cover for closing costs. It can sometimes be one or the other, and can be flexible. So you can start to think in terms of what kind of cash you have to bring to the table and what kind of cash you need, and can start to do a search on state websites, and learn from your state what kind of first time homebuyer program assistance they have.
Absolutely, and just remember to live and stay within your budget. And stay within your budget. The possibility and the potential of losing a home um, is
You
diminished.
may not understand every little one, but it's okay to ask questions about them and to be prepared that there will be these additional expenses that fall under the closing costs, and that there's something of value for each one of those expenses that can be a protection for you, as you go
Absolutely.
forward with the life of the loan and the property that you own. Audley, thank you so much for your time. I'm just going to share this last slide and thank the VHDA Homebuyer Handbook for all of their help and assistance, and all of the people at VHDA who have helped with our programming. We are just so grateful, and just want to say to you, thank you so much for your time. It means the world to us,
Thank you, sir.
and your expertise is phenomenal. Just to have this opportunity to have a lender walk us through all of these different ins and outs, it's just so helpful for me, and I know for so many people. And would just like to say to our audience, thanks for being with us, but also we have lots of videos. If you go to our Wider Path Home Foundation Facebook live page, or just Facebook events, and if you go to more and then choose videos, we have a whole host of videos that you can access that walk you through every part of the phase of pre-purchase all the way through to post-purchase, how to stay in your home, how to get into your home, how to stay there, and how to be successful as a homeowner. And all of these have been just tremendously helpful for me. So thanks for being with us, and we will see you next week. Same time, same place.